Aloha, I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants, and author of the books on the tax-free cash growth warehouse strategy. In this video, I will discuss the idea of rolling savings from a retirement account into a tax-free cash growth warehouse account. Retirement accounts. Most are also called qualified accounts because they qualify per the IRS to be tax deferred. Most are also funded with pre-tax money, such as 401ks, 403bs, TSPs, and standard IRAs. As such, they're subject to certain rules and restrictions. The obvious one is that since they are tax deferred, the money in those accounts are taxed as income whenever funds are withdrawn. Another restriction is that if you take money out of a qualified account before you reach age 59 and a half, in addition to the income tax on the withdrawal, there is a 10% penalty assessed by and paid to the IRS. There are also limits to how much you can defer into your qualified account per year. That limit is set by the IRS. For example, $13,500 per year is the max you can put into a simple IRA. And $19,500 is the max you can defer into a 401k. A little more if you're over 50 years old. Then there are the RMD requirements. RMD stands for Required Minimum Distribution or Withdrawal. And that rule requires that you take at least the minimum amount determined by the IRS as a distribution from your account each year, starting at your age 70 and a half. You can start withdrawing at age 59 and a half without any penalties, but you're not required to take the RMD until age 70 and a half. But if you don't start taking your RMDs when you reach age 70 and a half, the IRS will penalize you by taking 10% of your account's funds each year that you don't take the RMD. Which begs the question, who really owns my retirement accounts? What is apparent is you have a partner in your account holdings, namely the IRS. And isn't that a comforting thought? No? So those are the main rules and restrictions which qualify with qualified accounts. If your retirement account is managed by your employer or your employer's third-party administrator, you may or may not be able to take emergency loans from your account. If you do, you will be required to pay it back with interest according to their terms, not yours. Okay, with that in mind, most retirement accounts are invested in the stock market, usually through mutual funds and bonds, depending on the account management and or your direction for the investments. Often, the account may be divided into high, medium, and low risk funds in an attempt to balance out the risks inherent in investing in the stock market. Now, risk is a very important part of this discussion, especially now as the economy seems to be in such turmoil. The market is reactionary by nature, and it seems that every little thing affecting social stability or instability is making waves in the market, up or down. But the clear danger is that your money is at risk when it's in the stock market. It's true that your account can make terrific gains, but it's also true that all your money can be lost. More usually, what happens is with these accounts is that you will gain and suffer losses over time. That brings us to timing and sequence of returns. Early on in your career, and you're just beginning to build your retirement account, if you suffer a 50% loss in your account, it's not that big of a deal. What I mean by that is, if you have $10,000 in your account and you lose 50%, sure, that stings. But in the timing and scheme of things, it's not that big of a deal. You see, you still have plenty of time to make up for that loss before you reach retirement, and then some. But let's say you've had your retirement account for 45 years, and now there's like $500,000 in there, and you're planning to retire in just a couple of years. Well, if now there's a big market correction and you lose 50% of your savings, now that's a big deal. You think you'll have time to make up for that loss before you retire in just a couple of years? Not likely. And that's what sequence of returns relates to. By the nature of the market, your account will most likely suffer some losses along the way. But when those losses occur, can make a gigantic difference in the quality of your retirement life. Now, let's look at tax-free cash growth warehouse accounts. The money that you fund your TFCGW account with has already been taxed. So it is allowed to grow tax-free or indefinitely deferred, as long as you don't take actual withdrawals from the cash value. But then, even if you do, only the gains would be taxed. And there's never a penalty assessed by the IRS for taking a withdrawal. Regarding retirement income strategy with TFCGW accounts, if that's the main purpose for the account, and you want to basically dissolve the account over your retirement, you would take withdrawals or surrenders from the cash value up to the point where you have depleted the cost basis, which is the total you've paid in and does not include the gains earned over time. Because that money has already been taxed before you put it into the account, it will not be taxed again. Then, after the cost basis is exhausted, you would take policy loans against the balance, which would be the gains you made in the account. You take loans at that point because loans are not taxed either. So you get tax-free retirement income that way. And with your TFCGW account, you determine how and when, and even if you will repay any loans. It's entirely up to you, not the company and not the IRS. There really isn't a maximum that you are limited to as far as putting money into your TFCGW account. There is a limit you want to stay under, because exceeding that limit for your particular account will cause it to lose the tax-free growth aspect. And that's probably something you don't want to lose. But I have clients who have accounts that allow up to $100,000 to be added per year without affecting the tax-free growth. And it can be higher. It just depends on how the account is set up, and that depends entirely on you. But there are no RMDs or penalties regulating when or how much of your money you can use, no matter your age or youth. What about risk? There is no risk placed on your funds in a TFCGW account because they are not invested in the stock market. With the right companies, mutual companies, your account will grow by means of guaranteed interest and dividends based on the company's profitability. But your money is never at risk of loss. Now, remember here, a reminder here, When you take money out of your qualified account, you are required to pay income tax on that money. So if you are past 59 and a half and decide to pull money out of your qualified account and put it into a TFCGW account, you will still have to pay the current income tax on that money. Now, keep in mind that income tax rates are more than likely to increase in the coming years. So in that case, it may be better to take the tax hit now rather than later in retirement. Also, keep in mind that your money in any account invested in the stock market is at risk of loss, whereas cash value in a TFCGW account is not. So then, should you roll your money out of a retirement account and into a TFCGW account? A number of people have, but the decision is a personal one you have to decide after weighing the pros and cons to making such a move. You have questions, we have answers. We're here to help. If you have found this information helpful, please subscribe to this channel and share it with others. Also, post your questions and comments here. And if you haven't already, watch the free webinar, How to Become Master of Your Financial World. Just click on the link in the description box below. Our website link and all of our contact info is down there also. We look forward to helping you. For now, aloha and mahalo for watching.